What is a time frame? Let's start with John.
Well, a time frame is the time you use on your chart that you either 5 minute, 15 minute, or daily or weekly or monthly charts.
The period of time that you're looking at, where you look at the open, high, low, close
Okay.
of the different candles, if you're using candlestick charts,
Yeah.
or the range where you look at your data, if you're looking at a longer period.
All right. So I used to host a number of events throughout South Africa and the world, and there was one attendee that summed up a time frame perfectly in like one sentence, and that was the time it takes to complete a candle. If I had to sum up what a time frame is, a time frame basically shows you the market activity, which is the buying and selling prices during a selected period. So notice I used the word selected period because if you go look at any chart, all charts have different time frames, and there's proliferations and there's different worlds inside different charts, and that's why you need to pretty much stick continuously to the time frame that suits you best. So as you know, there are many types of time frames. When I started trading, I think the lowest time frame I could choose from was 15 minutes, and even 15 minutes time frame that I chose had a 15-minute delay, so I never had real life prices like I do today. So now you can choose periods from tick to seconds, minutes, hours, days, weeks, months, and even years. How do you choose your time frame?
Well, I wouldn't focus on just one. Make your decision on the larger time frame, and then go down one by one in the smaller time frames, and look for an entry point on the lower time frame. So if you see on the lower time frame the market's trending, say, downwards, and you're thinking of buying, you look at the lower time frame,
Okay.
and hopefully it'll be going down, so you get in on a good low price.
Okay, that's interesting. So you're a trader that looks at multiple time frames to base your decision on the larger market movement versus the time frame from when you're trading. So I assume you are a forex trader, Martin.
Correct.
Okay, John.
I do trade the FTSE as well.
Yeah, I'd say if you use larger time frames like weekly or monthly or maybe even daily, you could be a swing trader. But if you use the shorter time frames, then you could consider yourself as a scalper.
Great. So
But you'd
notice.
also,
So notice how John said if you want to be in and out of the market, you're a scalper, and if you want to trade longer time frames, then you're a swing trader. So once again, and it always boils down to who you are, what suits you best. And when I started trading, I would follow other traders' methods and time frames and markets, and it just did not fit who I was. And once you ask the question, who am I as a trader that makes me feel comfortable within the positions that I take, then you are on the right path to becoming a...
yeah, Timon, I'm still playing around with it.
And how do you feel
I'm checking it out because
when you take trades?
I think I've become more comfortable on the stock market with leaving it overnight. But when you look at Forex, it's, yeah, in the beginning, I had sleepless nights. So
Yes.
I prefer to get in and out. But I think these days, it's a lot to do with your mind. So it does, yeah, it's, I think getting your mind right, once you get that right, then you don't mind leaving it overnight.
Definitely.
Especially if you got your stop losses in place.
Absolutely. And stop losses aren't good enough nowadays as a forex trader, especially when non-farm payrolls comes out, because markets can jump stop losses. There's a lot of manipulation. So in South Africa, I don't know if you have this, Martin, but we have guaranteed stop losses where you pay a premium so that if the market does gap past your stop loss, it gets you out at the exact point that you, the maximum stop loss that you set. I don't know if you have that in London.
Some accounts do, yeah.
5 minutes. Let's look at a 5 minutes time frame. Popping up. All right. So here's a 5 minutes time frame. So by choosing a 5 minutes time frame when you trade means that you will be more of an active trader or an aggressive trader, that you want to be in and out of the markets. So if I was a scalper, I would choose 5 minutes up to about an hour, believe it or not. And this is because you will be taking a higher number of trades. There'll be more time spent on the screen. There'll be more trading setups. There'll be higher number of winners and losers, and there's more of an adrenaline rush and higher anxiety when you're trading shorter time frames. So you'll see there's gaps. You'll see there's lower movements between each candle. And if it suits you, then that's fantastic, and it's providing you the returns that you're hoping to gain, then you are winning. Remember, there are no rights and wrongs with trading. So when you're looking at a daily time frame, you're now becoming more of a conservative trader. And there will be less number of trades to take. There's less time spent on a screen, where, for example, I only analyze the markets once every couple of days. There's less anxiety and a more relaxed approach because you can see what to expect based on the historical movements in the markets. And there's less winners and less gains, but if you look at a number of markets, and all of a sudden it makes up the number of trades that you would take as a scalper.
Forex, I basically do 4 hour, 1 hour, and 15 minutes.
All right. So by doing multiple time frames, I assume you use a main trend versus the trend that you're in, and you try to line up the general trend and where it's more likely to go. Is that correct?
Yeah, that's correct.
Okay. And you use 4 hour, 1 hour, and daily. So does that mean you trade on the hour time frame?
Okay, for stocks I just use daily, but when I come to Forex, I use the 4 hour, 1 hour, and 15 minute. 15 minutes usually the entry chart that I use.
If you trade stocks, it is a similar way to trade if you drop it down to the 4 hour and you look at the daily in general, because if you think about it, a 4 hour time frame and a daily time frame, the difference is 2 candles.
Yeah.
That's it. So if you're more of an aggressive stock trader, you can even then try the 1 hour, 4 hour, and daily. Maybe that as a challenge for the week. Try that out as you're doing with Forex. See if you can do it with stocks. Obviously, the higher market capitalization type stocks, and you'll see that you'll be able to follow that type of trading method. All right.
Yeah, I'll test that out.
All right. Martin, when you're trading indices, do you look more at longer time frames or shorter time frames?
Well, I plot Fibonacci's on all of them and trend lines and look at support and resistance. And it's good if you can find all the time frames going in the same direction, although you don't often find that.
So are you also a multiple time frame trader?
I try to be, because if you get in, if the overall trend on the longer time frame is long, for example, and you've got in long and the market starts going down on the smaller time frames, then you can sometimes hang on and wait for it to return to the long-term trend.
Okay, and how long have you been testing the strategy for?
It's not really a strategy, it's more of an excuse when the market goes the wrong way. I try to talk myself into believing that if I'm patient, it'll...
I found a guy who was able to backtest the strategies that I've developed over the years. And we were able to optimize trading strategies with over 101,000 different variations of Fibonacci and MACD and RSI and stochastics and unbalanced volume and convergence and all these moving averages, and I'll tell you 0.5% showed some form of a positive return within the strategy. If you're not seeing consistent results within your type of trading, it means that there are too many elements and variables that you are incorporating, which changes according to the market environment, which can be a little bit disheartening when it goes your way and then it doesn't go your way. And as a trader, you want to endure the bad times with a good strategy, knowing that the good times will come back, rather than the bad times that you're going through now is because your strategy sucks. Once you have a strategy that is back tested, forward tested, and real tested in ways that you can see clearly the direction of how your trading performance will be over the next number of years, and also based on the past data and how it's reacted in the recession, all of a sudden trading becomes effortless and it becomes a natural way to go about in your life. Martin, what I've basically said is everything that you've done, Fibonacci and all that stuff, accumulated into a strategy, back tested 20 trades, forward tested 20 trades, real traded 20 trades, and find out where you have the point where the system is profitable, and then keep it going. As soon as you say the word excuse, it means that there will be variables in the future to change my mind on how trading will be. And then you'll realize, and you'll come to me and say, Timon, trading is boring. Like, I'm making money, but it's boring. And I'll say, well, now you know what you're doing. It's boring.
I'm just doing a course.
Yes?
Just doing a course now on backtesting and optimization on MT4.
Okay. And you also don't want to complicate your lives too much. Because, for example, if you have 3 time frames, those are 3 extra variables that you're incorporating into your trading might not be needed. So, like, if you're looking at a 4-hour time frame and a daily time frame, what is the difference? That, like I was saying to John, the difference is 2 candles. So then go look at your strategy and say, listen, I need to make my life easier. I'm going to look at the daily and I'm going to look at the hourly. And those are the only 2 time frames. Now all of a sudden you have something. And the daily is just as simple, is the trend going up? Yes, tick. Then you look at the hourly. Is the trend going up? Yes, tick. Done. Then you move to the Fibonacci. Are you looking at the 38? Are you looking at the 62? Are you looking at the 50, 100, whatever? And then you look at the risk to reward. How much am I willing to risk? How much am I willing to gain? And what is my win rate based on the back testing? Very important. The back testing is only based on 2 things, Martin and John: risk to reward, win rate. Everything else is irrelevant.
Yeah. Thank you.
Yeah.
John, your thoughts?
Yeah, I agree. Maybe a short time, like I said, about a year or something. Still going through some courses, so it takes time. I find, Tim, the biggest problem is my mind.
Yeah, me too. That's why I'm going into looking at expert advisors.
Yeah. You got to ask the questions, what is interfering with your mind? Is it the fact that you are losing trades? Is it the fact that you're losing too much money? Is it the fact that you're not profiting as much as you want to? Is it the fact that you need to be at your screen more time or less time than you think? You got to write down all these questions, because these are I can give you the questions, but I can't give you the answers. What time frame won't you use?
I don't use 30-minute or tick charts.
Speedy Gonzalez, John.
Hit the wrong button. I agree with Martin. I wouldn't use very low time frames. I think 5-minute time frames is the lowest. Otherwise, you just go crazy. It's
Sure.
too quick.
I go crazy with 30-minute time frames. So I think the lowest I go is 1 hour. I don't look at anything less than 1 hour.
I
Questions?
sometimes find though worth looking at the weekly to see if the market's going to head towards the weekly pivot.
Okay, so you're using the weekly as an analysis rather than a trading point to buy or sell.
Yes, I suppose you could say that.
The general view
Yeah.
is very powerful, and I think a lot of people go wrong when they come to analyzing is that they put too much heaviness on the fundamentals and the news rather than what the charts are doing.
Yeah.
They get their ego involved and they believe that the market's going to come down due to fundamentals. And what happens? It surprises them every single time. It does the opposite. In saying that, you use the charts as the main form of analysis. Then you can use the fundamentals as a base as to whether it supports or doesn't support the analysis. And if the fundamentals don't support the analysis, then you can consider your trade as a medium probability. And if it does go with your analysis, you can consider it as a high probability.